Hello, Leeb Group viewers. Today is Thursday, July 27th, the year 2010. Welcome to Leeb.com. The results of the stress test on EU banks meant to assure the public that the banks have enough capital to survive if the debt crisis worsens are out. More than 90 banks were tested, and with the exception of 7, all passed. Going in as the tests were meant to be a common pill for investors, the vast majority of the banks were expected to pass, so the results were no surprise. As in the case with the U.S. bank stress tests more than a year ago, there's plenty of skepticism whether the stress tests were rigorous enough or were they merely for show. For example, what would happen in the event of a sovereign debt default on this the scenario that most fear could trigger a full-blown financial tsunami was not even tested. The banks that failed, 5 Spanish banks, are already nationalized German mortgage lender, and Greece's ATE bank will have to raise 3.5 billion euros over a period of time still to be determined. The euro has rallied in July after falling to a 4-year low in June on some signs that European economies aren't as bad as feared, and the beleaguered countries like Greece, Spain, and Portugal appear to have satisfied debt obligations for the time being. The stress test results have been treated as positive reinforcement, even though their execution was likely flawed or not stressful enough. However, although it appears that a full-blown crisis has been averted for now, Europe's fundamental debt problems remain essentially intact. Still unknown how much damage the proposed austerity measures will do to the EU economies, while the more expensive debt means heavier burden to be repaid later. Banks, too, despite the stress tests, may remain hesitant to get credit flowing, acting as another headwind for EU economies. We still think that European investments should be approached with caution. Thank you so much. We'll see you tomorrow.